Imagine waking up tomorrow morning and opening your banking app only to see a message that withdrawals are temporarily limited, not because you did anything wrong, not because your account is empty, but because the system itself has decided to slow down the flow of money. For most people, that moment would feel like panic, but if you understand how financial systems actually work, that moment becomes something completely different. It becomes information. Banks operate on trust and liquidity, not on the idea that everyone will ask for their money at the same time. The entire financial system is built on the assumption that most people will remain calm and continue operating normally. But history has shown that during moments of uncertainty, governments and financial institutions sometimes restrict withdrawals to stabilize the system. When that happens, the difference between fear and opportunity is knowledge. The question is not whether restrictions can happen. They have happened in many countries before. The real question is this: if it happens again somewhere in the world, will you react emotionally like everyone else? Or will you understand exactly what to do in the first minutes when information becomes power and preparation becomes freedom? Most people grow up believing that a bank account is simply a secure container where their money sits patiently waiting until they decide to use it. It feels logical. You deposit money, it stays there, and you withdraw it whenever you want. But the real system operating behind that simple interface is far more complex and far more fascinating. A modern banking system is not a storage vault. It is a dynamic engine that continuously moves capital through the economy. When money enters the banking system, it begins working immediately. It funds businesses that build factories. It finances homes for families. It supports infrastructure projects that power cities, and it fuels innovation across industries. In other words, the money inside banks is constantly circulating through the bloodstream of the economy. This system is incredibly powerful because it allows a society to multiply productivity. Instead of money sitting idle, it becomes energy that pushes civilization forward. But this system also operates on a fundamental assumption about human behavior. It assumes that not everyone will attempt to withdraw their money at the same time. Liquidity is carefully managed so that normal financial activity can happen smoothly every day. People withdraw, deposit, transfer, and invest in predictable patterns. Banks are designed around these patterns. The moment those patterns break because fear spreads or uncertainty rises, the system experiences stress. This is where many people misunderstand what is happening. They assume restrictions or slowdowns mean the money has disappeared. In reality, what they are witnessing is the system protecting itself while it recalibrates. When a bank temporarily limits withdrawals during a crisis, it is not necessarily a sign of collapse. It is often a defensive mechanism meant to prevent a chain reaction. If everyone rushed to withdraw simultaneously, it could force institutions to liquidate assets too quickly, creating unnecessary instability. Slowing the flow buys time for the system to stabilize. From a systems perspective, it is very similar to how engineering safety protocols work. If a spacecraft detects an anomaly, it may pause certain operations while diagnostics run and systems rebalance. The pause is not failure, it is protection. When you understand this, you stop reacting emotionally to the headline and start analyzing the underlying mechanics. Knowledge creates calm. Calm creates clarity, and clarity allows better decisions. The people who panic during financial stress are reacting to uncertainty because they never took the time to understand how the system works. But when you study the architecture of finance, you realize something important. Restrictions are signals. They reveal where liquidity pressure exists and how institutions are attempting to stabilize flows. Observing those signals allows you to think strategically rather than emotionally. Instead of asking whether the system is breaking, the better question becomes what adjustments the system is making to restore equilibrium. Understanding this dynamic shifts your entire perspective. Rather than seeing banks as mysterious institutions controlling your money, you begin to see them as components of a massive economic machine that converts savings into growth. This machine powers innovation, construction, technology, and global commerce. But like any machine, it occasionally encounters friction when external shocks appear. Economic crises, geopolitical tension, sudden market movements, or widespread fear can temporarily disrupt normal flows. When that happens, the system adapts. Restrictions, policy changes, and liquidity controls are part of that adaptation process. The key advantage belongs to those who understand this reality before the moment arrives. When you are prepared mentally, you do not waste energy on panic. You observe, analyze, and respond intelligently. History repeatedly shows that calm thinkers outperform reactive ones during periods of uncertainty. The ability to stay rational while others become emotional is a strategic advantage in every complex system, including finance. This leads directly to the second powerful realization. Financial strength is not just about how much money someone possesses. It is about how resilient their access to that money develops. Many people unknowingly design fragile financial systems for themselves. They place all liquidity in a single bank account or within one financial channel and assume that access will always remain uninterrupted. In normal conditions, this seems perfectly reasonable, but resilient systems are never designed around single points of failure. In engineering, redundancy is essential. When engineers build rockets or spacecraft, they assume that components might fail under extreme conditions. Instead of hoping everything works perfectly, they design backup systems that activate automatically if something goes wrong. Critical systems have layers of redundancy so that even if one pathway fails, the mission continues safely. This philosophy has allowed humanity to send machines across the solar system and land rockets back on Earth. The same logic can be applied to personal finance. A resilient financial structure includes multiple channels of access. Different financial institutions create distributed risk rather than centralized dependency. When liquidity is spread across systems rather than concentrated in one place, temporary restrictions in one channel do not eliminate access entirely. This concept may sound simple, but it reflects deep systems thinking. You are not predicting failure. You are designing stability regardless of conditions. Resilience also extends beyond institutions themselves. Liquidity can exist in multiple forms. Digital balances inside banks are one form. Brokerage accounts, investment platforms, and other financial networks represent additional channels. Even physical stores of value have historically played a role in providing optionality during uncertain periods. The goal is not complexity for its own sake. The goal is flexibility. When the system experiences stress, flexibility allows movement while rigid structures break. This mindset transforms financial planning into systems design. Instead of focusing solely on how much money you accumulate, you focus on how intelligently your financial architecture is built. Access pathways become as important as asset growth. Redundancy becomes as important as returns. Just as an advanced technological system requires multiple fail-safes, a strong financial system benefits from multiple liquidity pathways. People who build this kind of structure experience uncertainty very differently from everyone else. When restrictions appear, they do not feel trapped because they understand that their system was designed with resilience from the start. While others scramble for solutions during a crisis, they simply shift activity to alternative channels that remain open. That difference in experience is profound. It transforms a stressful moment into a manageable adjustment. At a deeper level, this philosophy reflects something broader about how intelligent systems operate. The future belongs to structures that are adaptable rather than rigid. Whether we are talking about technology, economics, or human decision-making, flexibility allows survival and growth under unpredictable conditions. The world is becoming more complex, more interconnected, and occasionally more volatile. Systems designed with redundancy and adaptability will always outperform those built on fragile assumptions. When you look at finance through this lens, it stops being a passive activity and becomes an active design challenge. You are not just saving money, you are building a resilient personal financial network capable of operating even when conditions change. This mindset empowers you because it replaces dependence with architecture. Instead of hoping systems never experience stress, you prepare intelligently so that stress does not disrupt your life. Once you start thinking this way, you realize something interesting. The same principles that guide advanced engineering and technological innovation can guide personal financial strategy. Redundancy, resilience, flexibility, and system awareness are not just concepts for spacecraft or artificial intelligence. They are universal principles that apply to any complex environment where uncertainty exists. Finance is simply another system where those principles create strength. And when people begin designing their financial lives with that level of awareness, something remarkable happens. Fear disappears, not because the world becomes perfectly stable, but because their system is built to operate even when instability appears. Confidence replaces anxiety because preparation transforms uncertainty into manageable complexity. This is the real power of understanding systems. It allows individuals to operate with clarity and control even when others feel overwhelmed by unpredictability. When financial systems experience stress, something fascinating begins to happen at a human level. People start questioning the difference between digital numbers and real value. Most of modern finance exists as electronic signals moving through servers, databases, and networks that span the globe. This system is incredibly efficient. It allows billions of transactions to occur instantly, supports global trade, and enables innovation at a scale humanity has never seen before. But during moments when banking access tightens or uncertainty spreads, people instinctively search for something more tangible. They begin asking a fundamental question that civilizations have asked for thousands of years. What actually holds value when systems slow down or pause? The answer to that question reveals why certain assets have survived every financial era in history. Throughout time, societies have returned again and again to stores of value that exist aside institutional control. Precious metals like gold and silver have held this role for centuries because they combine scarcity, durability, and universal recognition. They do not rely on digital infrastructure or government policy to exist. Their value emerges from physical reality. This does not mean technology-based finance is weak or flawed. In fact, the digital financial system is one of the most powerful tools civilization has created, but balance matters. Systems that combine digital efficiency with tangible resilience tend to be stronger than systems that depend entirely on one layer. When people suddenly realize that access to their money might temporarily depend on institutional decisions or network stability, their perception of value begins to shift. It is not fear alone that drives this shift, it is awareness. They start recognizing that diversification is not only about different investments, but also about different forms of ownership. Some assets exist as digital claims recorded on networks, others exist physically and can be held directly without an intermediary. Both forms have advantages, but understanding their differences gives individuals strategic flexibility. Imagine looking at finance the way engineers look at energy systems. A city powered entirely by one source of electricity would be vulnerable. If that source failed, the entire grid would collapse. But a city powered by multiple energy sources becomes resilient. Solar power, hydroelectric power, wind power, and stored energy work together to create stability even if one component temporarily falters. Financial systems follow the same logic. When all value is concentrated in one format, the system becomes fragile. When value is distributed across multiple forms, the system gains resilience. This perspective is not about abandoning the future. In fact, the future will almost certainly become more digital, more interconnected, and more technologically advanced than ever before. But intelligent design always includes redundancy. Even the most advanced spacecraft ever built include mechanical backups, manual overrides, and alternative pathways. The reason is simple. Real-world systems must function even when conditions are unpredictable. Finance is no different. Physical stores of value have historically played an important psychological role during uncertain times because they represent ownership without dependency on complex infrastructure. When someone holds a physical asset, they know its existence does not rely on servers, databases, or institutional permissions. That independence creates confidence, and confidence itself is a powerful economic force. Markets are driven not just by numbers, but by human belief in stability and reliability. The fascinating part is that when uncertainty rises, assets with these characteristics often become more attractive because they represent certainty within uncertainty. People gravitate toward them not because they reject technology, but because they instinctively seek balance. This pattern has repeated through financial history again and again. Each time systems evolve, people rediscover the importance of combining innovation with resilience. Once individuals understand this dynamic, their thinking shifts. Instead of reacting emotionally to financial stress, they begin constructing strategies that integrate multiple layers of value. Digital finance continues powering efficiency and global access. Tangible assets provide stability and optionality. Together, they create a system capable of adapting to many different conditions. The result is not fear of the future, but intelligent preparation for it. At the deepest level, however, the most powerful factor in any financial moment is psychology. Systems can be complex, poly. The seas can change, markets can fluctuate, but the most dramatic movements often come from human behavior itself. When uncertainty spreads, people react quickly. They withdraw funds, sell assets, chase safety, or follow the crowd. These reactions create waves across the financial system. Prices move rapidly, not only because of economic fundamentals, but because millions of people are acting based on emotion. This is where a different kind of advantage appears. Individuals who understand systems deeply often see moments of volatility not as threats, but as signals. Fear distorts perception. Fear distorts perception. When large groups react emotionally, markets frequently move beyond rational valuations. Assets become overpriced or underpriced because panic replaces analysis. Strategic thinkers watch these moments carefully because they reveal where the collective psychology of the market is temporarily misaligned with long-term reality. History shows that some of the greatest opportunities emerge during periods when uncertainty dominates headlines. Entire industries become undervalued because investors are focused on immediate fear rather than long-term potential. At the same time, new technologies, new financial models, and new economic structures often accelerate during these moments. Pressure forces innovation. When systems encounter stress, humans respond by building better systems. Consider how technological progress has historically surged during periods of disruption. Challenges push engineers, entrepreneurs, and scientists to rethink old assumptions and design new solutions. Financial systems evolve the same way. Crises reveal inefficiencies and vulnerabilities that were previously invisible. Once exposed, these weaknesses inspire innovation. New forms of digital currency, decentralized finance, advanced payment infrastructure, and alternative asset networks begin to emerge precisely because fee set. People recognize the need for more resilient systems. This cycle of stress, followed by innovation, is one of the most powerful forces shaping the future of finance. Moments that initially appear negative often become catalysts for progress. People rethink how money moves, how assets are stored, and how financial access is structured. Entrepreneurs begin building platforms designed to remove single points of failure. Engineers design technologies that increase transparency and speed. Investors shift capital towards solutions that strengthen the system. The individuals who thrive in this environment are those who remain calm enough to observe the transformation as it unfolds. They are not distracted by the noise of fear because they understand the deeper pattern beneath it. Markets are not random storms. They are dynamic systems constantly adjusting to information, incentives, and human behavior. When panic erupts, it often signals that the system is entering a phase of recalibration. Calm observation during these moments becomes a strategic advantage. Instead of rushing to react, analytical thinkers step back and ask better questions. What is the system signaling about liquidity, policy, and technological evolution? Where is capital flowing and why? Which industries will benefit from the adjustments happening beneath the surface? These questions reveal opportunities invisible to those who are focused only on immediate fear. The most important insight is that financial systems are reflections of human civilization itself. They evolve as societies evolve. New technologies reshape how money moves. New policies reshape how institutions operate. New generations reshape how people think about ownership and value. When stress appears, it does not end the system. It forces the next stage of evolution. Those who understand this do not simply react to financial turbulence. They analyze it. They recognize that moments of instability often reveal the direction in which the future is moving. By remaining calm, curious, and analytical, they position themselves ahead of the crowd. Fear fades and clarity emerges because they see the system not as something collapsing, but as something transforming. When you step back and look at the bigger picture, moments when banks restrict withdrawals are not just financial events, they are signals that the system is under pressure and trying to stabilize itself. The important lesson is not to react with fear, but to understand how these systems actually work. Money, banking, and markets are complex networks built on confidence, liquidity, and human behavior. When stress appears, the system adjusts, and those adjustments reveal where resilience truly exists. The individuals who understand these dynamics remain calm while others panic, and that calm thinking allows them to make smarter decisions at the exact moment when clarity matters most. True financial strength does not come from simply having money sitting in one place. It comes from understanding systems, building resilience, and designing your financial life with flexibility and awareness. Diversified access, balanced assets, and a clear understanding of how markets behave during uncertainty create a level of control that most people never experience. When you think like a systems engineer rather than a passive participant, financial uncertainty becomes something you can analyze and navigate rather than something that controls you. Every major shift in the financial world teaches the same lesson. Preparation creates confidence, knowledge creates freedom, and those who take the time to understand the mechanics of money are always better positioned when a system experiences stress. Instead of being surprised by events, they see them as part of a larger pattern that reveals where the future is moving. Thank you for watching and spending your time exploring these ideas. Your curiosity and willingness to understand the deeper mechanics of finance already puts you ahead of most people. Stay informed, stay analytical, and keep learning how the systems shaping our world really work. Thanks to all of you for watching.